Hey everybody, welcome back. And in the last video we saw and we concluded that we should be completing the picture for a company. We should be looking at a lot of indicators for a company for our quantitative analysis. But why is this required that we look at different indicators of a company, different financial indicators of a company? The reason is, let's say you are a person, you looked at only one indicator and this is really positive. You took the decision that, oh, because of indicator A, let's say that is PE ratio of a company, that is really great. Then you will be making a decision that probably I should be investing in this company whose indicator A is very positive. But it may be possible that the indicator B, C, and D are negative. A person who is looking at the complete picture will be knowing that this is positive, negative, 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 and probably he will not be investing in the company. You made a wrong decision to invest in this company. And the flip side is also correct. Let's say you looked at one of the indicators only. Indicator D is very negative for this company. You made a decision that I am not going to invest in this company because, let's say, the debt to equity ratio of this company is very high. So I will not be investing in this. But if you look at the other things, on the other parameters, the company is performing really well. You will be knowing, a person who is looking at the complete picture will be knowing that this is the negative aspect of this company, but all other aspects of the company are positive. And once he does the deep dive into this picture, he wants to see why is this negative. And maybe because for this red flag, he finds out a reason that it is having debt to equity ratio is really bad for this company because of so and so reason. Then he will be able to look at the complete picture rather than just looking at one indicator. So all these indicators, all these financial parameters of a company, A, let's say indicator A, B, C, and D, they are not divorced from each other. They are married to each other. That's why we have to look for the complete picture. Having said that, let's come to the first few ratios of a company, first few financial fundamental indicators of a company. Let's take for our analysis company A and company B. Now, your favorite YouTuber comes to you and he says, hey, buy the stocks of company A. Why? Because it's making $100 per annum. Its earnings are $100 per annum. And the earnings of company B are, let's say, only $10 per annum. Now, firstly, for EPS, that is earnings per share, and PE ratio, that is price to earning ratio, the earnings that we have is the net income minus the dividend paid out by the company. Now, just by looking at the price, the earnings, which is dividend subtracted out of it, this can be very fuzzy, just the number of earnings, that is $100 and $10. How? It may be possible that the company A didn't give any dividend. It gave zero dividend. So the net income is actually $100 only for company A. And let's say company B gave a dividend yield of almost 100% of their earnings or 90% of their earnings. And if they gave 90% of their earnings as the dividend yield, so probably they gave $90 out as dividend. That is payout to the shareholders. And $10 they kept as the net income, as the earnings. So their total net income will be 10 plus 90 is 100 was the net income, but 90 they gave out as dividend and 10 they kept as their net earnings. And company A gave $0 as dividend and kept the whole amount as the net earnings. So just by looking at the earnings number, if you're looking at the earnings number, just quickly see the dividend payout as well. That how much is the dividend payout of the company. All right. Now let's say the earnings of company A is $100, company B is $10. They didn't give out any dividend. Let's assume the dividend payout is zero for both the companies. Does that mean company A is a worthy investment than company B? It may not be true. You start a quick analysis of EPS. Let's say for $100, the company has issued 100 common shares. Company A has issued 100 common shares still. But company B has issued only one share or two shares till now, two common shares till now. There are only two shareholders for this company, and there are 100 shareholders for this company, common shares. Now, these earnings have to be distributed among these 100 people. And this $10 earning is going to be distributed among two shareholders, two shares. That's why we calculate earnings per share, not the total absolute earnings. We look at the earnings per share of a company. It's a measure of profitability only. Profitability benchmark to number of shares. Earnings benchmark to number of shares. So the earnings per share of company A is $1 and company B is $5. 10 divided by 2. Then probably you'll be making a decision. Why I am concerned about this thing, that how much is the earnings of company B? It is giving me better earnings per share than company A. So probably at this level, your decision might be that I should be going for company B. Not yet. Now, the earnings per share of company A is $1. Earning per share of company B is $5 given. So with an assumption, the dividend payout is same for both the companies. Now, but we have to make our investment decision not only on the earnings of a company, but how much we are going to buy a company share for. What is the price of company A? It may be making a lot of money, but if the price is really high for that company, then probably we should not be investing for that much earnings. So for that benchmarking, that for these earnings per share, how much is the price that I am paying? That ratio is called PE ratio. Price to earnings per share. Let's say the price of company A share right now is $10 only. So price to PE ratio, price to earnings ratio will be equal to 10 divided by 1, that is 1. 10 only. But the price that we are paying for company B, that is PE ratio for company B, if we are calculating, let's say the current stock price of that company is $500. Then PE ratio will be 500 divided by 5. That is, PE ratio will be $100. If company A's price is 10 and current EPS is 1, earnings per share is 1, then probably I'll be paying for a PE ratio of 10. Here we'll be paying for a PE ratio of 100. It is making $5, but the price of the share B is $500. So probably this is not the right decision to take. This is the right decision to take if we are looking at the PE ratio. Another way of looking at the PE ratio is Let's say if a company is making $1 earnings per share and you're going to buy only one share only, and the price that you're paying for a company is $10, then how many years it will take for your investment to be back? Forget about the profit. How many years it will be taking for your investment to be back? Assuming that every year the company is going to earn $1 only for each share. So if they are earning $1, then it will take 10 years for your investment to be back. How? They will be doing $1 this year, next year $1, assuming linear profit growth. That profit is not growing, profit remains stable. $1 this year, next dollar, next $1, next year also $1 only. No profit growth, assuming. Then it will take me 10 years if the company keeps earning the same amount. Doesn't go up, doesn't go down. So we are looking at a snapshot that today, this is the PE ratio of this company. And it will take my investment 10 years to be back. How many years it will be back for this company? $500 is the price that I am paying for one share. It is earning $5 per share. So it will take me 100 years to get my investment back on. That's why the EPS and PE ratios are a good indicators to analyze, but not the only indicators. We'll keep learning about these financial ratios going forward, but we need a back of the envelope calculations for each and every company. Now, it doesn't mean that you start calculating the EPS and PE ratio for each and every company. It will take you a lot of time. For that, we have tools. The best tool out there for Indian equities is called Screener. Let me share my screen and show it to you. For example, this is a screener.in. You go and put the company name, and then you can have different ratios over here. If you want to add a ratio over here, for example, earnings per share, EPS, then you can add the EPS over here. And the EPS will start showing that it is 17 per share, 17.6 rupees per share earnings for this company, which is called Kirloskar Ferrous. All right. And then you can see what is the PE. Stock PE is 35.1. All right. So, but when you make an account or open the screener.in, there will be only few basic ratios. For example, stock PE will be there, ROCE will be there, ROE will be there. We'll talk about all these ratios tomorrow or in subsequent videos. But if you want to add, then you can add earnings per share, EPS, right here. Okay, I need to log in, but don't worry about that. I have already shown you that how to add. You can edit the ratios also. If you want to remove some of the ratios, you can remove some of the ratios. You can have the number of shares also. Number of shareholders. All right. And number of shareholders and number of shares also. Number of equity shares in the previous year. All right. Some things are for the premium account, but generally for the basic indicators, you can just have the free version of the screener will be helpful quite a lot. All right. You can look at the stock PE, you can look at the industry PE of that stock. Probably this is a little bit expensive stock than the competitors because competitors are having 29.6 industry PE. All right. So we'll keep talking about these things in the subsequent videos.